In this video, I'm going to start into Chapter 18. Chapter 18 is all about performance evaluation. That is, ways to measure how am I doing in my investing. To help set our thinking, consider the following scenario. Assume you're a portfolio manager. Then your goal as a portfolio manager is to provide value to your clients. And the basic question of performance evaluation is the following. Are you earning a sufficient return for your level of risk? That is, you should be getting rewarded for the risk that you're taking on, and you want to be able to show that to your clients. Okay, we're going to see that there are different performance metrics that people will use to measure their performance. And one of the things to note is that many of the differences in performance evaluation can be interpreted as how you define risk in this statement, right? Are you earning a sufficient return for your level of risk? What kind of risk are we talking about? Let me give you some examples of this. The first one is a very informal notion of risk, okay? So the first one would be, are you outperforming your peer group of funds? This is a very common thing to do. If I invest in domestic equities, that is US stocks, then likely I'm going to be compared against other people who invest in US stocks. Why compare me against other people who are investing in US stocks? Because it's likely that we're all subject to the same kinds of risk. So that's why it makes sense to compare me against them and not compare me against somebody who is, trading internationally or trading natural resources or something like that. So the underlying assumption in this one would be peer groups are assumed to have similar risk, and that's why it makes sense to compare. Okay, that's sort of an informal notion. We're going to get into more formal notions of calculations of performance measures. And we'll see things like this. Do you outperform for your level of standard deviation? That's essentially the Sharpe ratio. The Sharpe ratio, the notion of risk, is standard deviation. We'll see others as well. For example, do you outperform for your level of specific risk? We'll see some measures related to that. So again, I think a good way to think about the material that we're going to cover is it's trying to address this question, are you earning a sufficient return for your level of risk? But then the differences will be in how are you defining risk? What risk are you looking at? Okay, with that as background, let's start into the material here. And I'm going to cover in this video the first section, and it's a pretty long section. And I'm calling these CAPM-based performance measures. Why am I calling them CAPM-based? Well, basically to calculate these, you need the basic parameters from CAPM. What is that? You need things like beta, specific risk, and alpha. Okay, so that's why I'm calling them those. So we're going to see a couple of them in here. We're going to go through Sharpe ratio, M squared, trainer measure, and alpha or information ratio. Let's dive right into it. Okay, so we're going to look at performance measures that I'm saying is based on CAPM, or alternatively, you can think of it as based on an index model. Before calculating any of these, there's sort of a pre-step, okay? What is the pre-step? So what information are we going to need? We're going to need things like, of course, expected return and standard deviation, but we're also going to need things like the beta of the stock, right? The alpha of the stock. We remember that alpha is sort of comparing your return to what CAPM predicted. We need things like specific risk. How do we get that information? Now I'm going to remind you from material that we saw related to CAPM. What do? We're going to take data and we're going to run a regression. Hopefully you remember what that was called. That was called doing a security characteristic line. So the first thing that we would do, and I'm not going to make you do that here, but the first step that you would do before you can calculate any of these is to create the security characteristic line. Let me just briefly remind you of that and what information we get out of that. So security characteristic line on the x-axis, what do? I take the excess return of the market. Like, what did the market do? On the y-axis, I take the excess return of whatever I'm interested. In this case, it'll be our portfolio, right? And you put down that historical data, and what do you get? You get a whole bunch of data points, and then we run the best fit line. That best fit line is called the security characteristic line. And then let me remind you of the connections. So we run that regression, and out of the regression, what do we get? So beta, we're going to get the beta of, in this case, it would be our portfolio, but this is where beta comes from. That is a measure of the response of the stock to the market index. That's our measure of market risk. And what does that correspond to? That corresponds to the slope of the line, so that's where that would come from. We also get a measure of specific risk, if you remember that, specific risk, or the error term. That is the distance of the points to the line. And we also get the historical alpha of whatever we're looking at, and that actually corresponded to the y-intercept. And remember, alpha is just comparing it against what CAPM predicted. So this would be your first step. You would take data about your portfolio, about your performance. You would run the security characteristic line, and that would allow you to estimate beta, specific risk, and alpha. Okay, so going forward, we're going to assume that we have this information. All right, so with this information now we can begin to calculate different performance measures. Let's start with one that hopefully we're very familiar with by now, the Sharpe ratio. So this will be a reminder. So what is the Sharpe ratio? So the Sharpe ratio, let me remind you, in the numerator, what do I have? I've got the risk premium. And think of this as a measure of reward, right? So that's reward. And in the denominator, what do I have? I have my notion of risk, and here risk is measured by what? Volatility or standard deviation. I want you to focus on that because lots of our measures are going to look like this. There's going to be some notion of reward on the top and risk on the bottom, and we're just going to swap these things out. But many will have a similar flavor to the Sharpe ratio. Okay, let me remind you of the context of the Sharpe ratio, because we're going to get a number of measures, and I want you to know not only how to calculate them, but when they're appropriate. So where did the Sharpe ratio come from? Okay, so the Sharpe ratio came from what? We had mean standard deviation diagrams. So remember, this was standard deviation, this was expected return. Okay, and so right here, we should note that because Sharpe ratio was related to these mean standard deviation plots, that standard deviation is our notion of risk. So the risk in the Sharpe ratio is the standard deviation of your entire portfolio. And let me remind you of a couple of things. So here was the most important thing related to these diagrams. If you're looking at your overall portfolio, right, and you draw a capital allocation line, then the Sharpe ratio was equal to what? The slope of the capital allocation line. Okay, so hopefully this is a reminder. And what was a couple of the ideas that came out of this? Let's look at that. According to CAPM, the market had the highest Sharpe ratio. So a very common thing to do is to take your portfolio, calculate its Sharpe ratio, take the market portfolio, calculate its Sharpe ratio, and according to CAPM, you shouldn't be beating the market. So if you are beating the market, that is, if you have a portfolio that has a Sharpe ratio that's meeting the market, then you can really show that you're doing something, okay? You can really show that you're adding value. So that's a very common thing that you would do. All right, thus, what is the takeaway here? Sharpe ratio, our notion of risk is standard deviation. It's related to these mean standard deviation diagrams. And Sharpe ratio, in general, is used for ranking entire portfolios. You want to compare your overall portfolio against, for example, something like the market. And that would give you an indication of whether you are adding value relative to the market or not. Okay, as I go through these different performance measures, I'm going to jump over to an example here. And this example has different portfolios. So there's portfolio P, portfolio Q. There's our benchmark. Think of our benchmark as the market. That's what we're comparing against. There's cash over here, although that's not that important. And then what we have here are, these are the things that you would calculate in order to use these performance measures. So you would calculate these things like excess return. That's in the numerator of the Sharpe ratio. You would calculate standard deviations of all these things. You would also do the security characteristic line. You'd get beta, you'd get alpha. Residual standard deviation, that's a name for what? That's a name for the specific risk, so you would get that. So you would calculate all these things. All right, once you have these, then we can start moving to the performance measures, and the first one we saw here was the Sharpe ratio, and you calculate that for portfolio P. What do you get? 0.398. You calculate it for portfolio Q, 0.30, and for the benchmark, that's the market, 0.34. Okay, so what do we note here? Which portfolio is the best, right? Which portfolio has the highest Sharpe ratio? Portfolio P has the highest Sharpe ratio. Okay, that's great. What does this mean for us? So let's ask a question here. Would you use portfolio P as your single risky portfolio in a capital allocation line? Why or why not? Think about your answer to this. So the answer should be yes, I would use it as my single risky portfolio in a capital allocation line. And that's remembering the connection that the Sharpe ratio is the slope of the capital allocation line. So here portfolio P in particular is beating the Sharpe ratio of the market. So there you're showing, hey, I'm beating CAPM. CAPM says I shouldn't be able to beat the Sharpe ratio of the market, so I'm really adding value. So you'd have a very, very strong case there. All right, since portfolio P is beating the market, it would be appropriate to use as your single risky portfolio in a complete portfolio. So your complete portfolio would place some money in P and the rest in the risk-free asset. Okay, so that was just a reminder of the Sharpe ratio and the context that it comes up in. Let's move to our next measure, and our next measure is actually going to turn out to be equivalent to the Sharpe ratio. And what is the issue here? If I go back, and let me go back here, and I look at these Sharpe ratios, and I see a number like 0.39, right? And I say the market is 0.34. And yeah, okay, that's beating the market, but Sharpe ratio is not very easy to interpret. The question is, well, is that beating the market by a lot? Is it beating the market by a little bit? I don't know, okay? Unless you have a lot of intuition with the Sharpe ratio. So the next measure that we're going to talk about, the so-called M-square measure, right here, this is one that's going to basically take the Sharpe ratio and it's going to make it much easier to interpret. Let's see how that works. Okay, again, this is called the M-square measure. And the M-square measure you should think of as a modification of the Sharpe ratio in order to make it easier to interpret. Let's see what it exactly does. So the idea is to compare the difference between the expected return of your portfolio and the expected return of the market. However, under the assumption that your complete portfolio is chosen to have the same standard deviation as the market. Essentially, you are going to match the risk level of the market. You're going to match the standard deviation of the market, and then you're going to compare expected returns. Let me show you that in pictures. I think it's easier to understand it in pictures than it is in this statement. So here's what the picture looks like. We are in a mean standard deviation diagram, right? That's our standard diagram. And the market is sitting right here, okay? And so what is the risk level of the market? It's sigma sub m, and the market also has some expected return over here. Okay, and you can think of the capital market line, right? And this comes from CAPM, and CAPM would claim that the capital market line should have the highest Sharpe ratio. All right, now let's assume here is your portfolio P. Are you beating the market in terms of Sharpe ratio? So you look at this and you say, yes, I have a higher Sharpe ratio than the market. How would I know that? I would draw the capital allocation line here, and I see that it's steeper than the capital market line, which is the capital allocation line for the market, and I've got a higher Sharpe ratio. So yes, I am beating the market. I have a higher Sharpe ratio. However, it's not really clear to me what that means, okay? So here is the idea behind the M-square measure. So the M-square measure says create a complete portfolio on your capital allocation line, but match the risk so that it has the same standard deviation as the market, okay? So that would be scale yourself down this capital allocation line to this point. Now you have the same risk. Now if two portfolios have the same risk, you don't need to worry about their risk. Just compare their expected return. So the M-square measure says, okay, I'm going to scale you down there so you've got the same risk as the market, and then I'm going to look at your difference in what this ends up being the difference in expected return. And so that difference in expected return is what we define as the M-square measure. Okay? Now, this is much easier to interpret than the Sharpe ratio. Why? Because M-square measure is going to be a number like 2%. And if it's 2%, what does that mean? How do we interpret it? It's the following. It says, hey, if you had scaled yourself down the capital allocation line, okay, so that you had the same risk level as the market, you would be beating the market by 2% per year. That's very easy to understand, right? So if you have a positive m-square measure, what does that mean? Oh, you would, if you'd taken the same risk as the market, you would have beat it by that m-square measure. If you have a negative m-square, like maybe it's minus 1%, then that says, hey, actually, if you had used the same risk as the market, you would have been losing to the market by 1% per year. Again, very, very easy to interpret, very easy to, explain to clients. All right, so this is the m-square. This is the interpretation of it. Let me give you the formula. So formula, very important here. Put some stars by this formula. So the m-square, what is it interpreted? It's interpreted as this P star portfolio. The P star portfolio is what? The portfolio with the same risk as the market, minus the expected return on the market. So this is how you interpret it. Here's the formula for it. And a good way to remember this formula is to remember that the m-square measure is based on the Sharpe ratio, right? So it's equivalent to the Sharpe ratio in terms of rankings. So what do? To calculate it, you take the Sharpe ratio of your portfolio. You subtract off the Sharpe ratio of the market. Again, that's that comparing the Sharpe ratios. And then you're supposed to match the risk. So to match the risk, what do? You take that difference in Sharpe ratios and then you multiply it by what? The standard deviation of the market. So that is the formula for it right here. Make sure you have that starred. All right, let me show you this in pictures, what this would look like. So I've got the market sitting right here, okay? And so I have the capital allocation line using the market. We call that the capital market line. All right, here's my portfolio. P is right here. Am I beating the market? Definitely. You can just eyeball it. I've got a steeper slope. I've got a higher Sharpe ratio. So my Sharpe ratio is definitely better than that of the market. However, that's not that easy to communicate. So instead, I'm going to calculate the m-square. So to calculate the m-square, what do? I scale myself down so that I am matching the risk level of the market, and that is that P star portfolio. And then I look at what its expected return is, 7.37%. I compare that to what the market's expected return is, 6.37. How much am I beating the market by? Oh, 1%. So there's my m-square measure. Let's verify that that's what you get out of the formula. What did we say you need to do in the formula? Well, you need to take the Sharpe ratio of your portfolio right here, and I need to subtract off the Sharpe ratio of the market. That's right here. So those are those differences. And then remember, I'm matching the risk levels, so I multiply by the standard deviation of the market. That's the 18.5%. And I do that, and I get what I would expect it. I get that 1%. Okay, so that's the formula for calculating the m-square measure. Again, the whole purpose of this is to make the Sharpe ratio easier to communicate, easier to interpret. Okay, so let's jump back to our example. We had portfolio P that had a Sharpe ratio of 0.398. I had portfolio Q that had a lower Sharpe ratio of 0.306, and I had the benchmark. Again, think of this as the market Sharpe ratio of 0.344. And I'm trying to communicate, what does that mean that portfolio P beat the Sharpe ratio of the market? Is that a big deal? Is it not a big deal? I calculate the m-square measure, and what did I get? I got an m-square measure of 1%. So now I can interpret that in an easy way. I can say, hey, if you had used portfolio P but scaled it so that it had the same risk as the market, it would have beat the market by 1%. I can also look at portfolio Q. I know portfolio Q was losing to the market in terms of Sharpe ratio. What does that mean? Again, I can calculate its m-square. It's negative, and this would say, hey, if portfolio Q had used the same level of risk, that is the same standard deviation as the market, it would have lost to it by how much? 0.72%. Okay, so to summarize here, m-square is a modification of the Sharpe ratio. It ranks things exactly the same as the Sharpe ratio. It just does it in a way that's easier to interpret. So think of it as equivalent to the Sharpe ratio. The fund with the highest Sharpe ratio will also have the highest m-square measure. The fund with the lowest Sharpe ratio will have the lowest m-square. Again, ranks things exactly the same as the Sharpe ratio. We interpret m-square as what? It's the expected return amount by which we can beat the market using exactly the same amount of risk. Okay, and that is much easier to communicate to a client and to interpret. Okay, Since it is the same as ranking by the Sharpe ratio, and we said Sharpe ratio was appropriate for what? Your overall portfolio. Again, people commonly use it to compare to the market. Then the M-square measure is appropriate for your overall portfolio. Okay, so M-square is a modification of the Sharpe ratio. We'd seen the Sharpe ratio before. Let's turn our attention now to a new measure. This one is called the Trainer measure. Okay, what is the Trainer measure? So the Trainer measure, or the Trainer index, is similar to the Sharpe ratio, but instead of dividing by standard deviation, we're going to see that it uses systematic risk, right, instead of total risk. So systematic risk. Here's the formula. So I'm going to call it capital T. In the numerator, what do I have? I have got the same thing as the Sharpe ratio. I've got the risk premium. That is my measure of reward. But however, in the denominator, what do I have? I don't have standard deviation. I have beta. What is beta? Well, beta is a measure of market risk. So now here my notion of risk is market risk, not total risk, but market risk. Okay, and that's really the only difference. So remember this for the formula. Here's a way that you can interpret the Trainer measure, although I don't know if it's the best way. So if it doesn't resonate with you, that's fine. You can basically ignore this. But because the Trainer measure divides by market risk, right, or beta, beta is our measure of market risk, or how sensitive something is to the market. We had a plot. It was called the security market line, and the security market line was basically just the CAPM equation. Okay, so we had the CAPM equation, but the key thing is that on the x-axis we used beta. So one way to interpret the Trainer measure is that if you've got a portfolio sitting up here, you can actually draw a straight line through it, and the slope of this line is the Trainer index. Now, I hesitated a little bit to show you this. Why? Because I don't want you to get it confused with the Sharpe ratio and capital allocation line. So if this doesn't resonate with you, just ignore that and go over to the formula here. And that's the key thing to remember. Trainer index is risk premium divided by beta. Beta is our measure of systematic risk or market risk. All right, when would you use this? Why not just use the Sharpe ratio? When would somebody go and look at the Trainer measure, the Trainer index? All right, let's look at the key property of it. The Trainer index, its notion of risk is only systematic or market risk. When would you only care about market risk? So if you only care about market risk, you're ignoring what kind of risk? You're ignoring specific risk. When is it okay to ignore specific risk? Let's think about that. So there needs to be the assumption that the firm's specific risk will be diversified away. That is when you could say, hey, it's okay for me to ignore specific risk because I know I'm going to diversify it away. So the only risk that I really care about is market risk, and that is beta is our measure of that. Thus, the Trainer measure is appropriate for a stock or a portfolio that you know you're going to combine with others, and at the end of the day will be part of a well-diversified portfolio. Okay, so there is that underlying assumption. Let's take a look at this. So now I can go back and I can look at portfolio P, portfolio Q. Again, the benchmark is the market here. And I can go and I can calculate their Trainer measures. Again, how would I do that? I would take risk premium and I would divide it by their betas right here, right? I would divide by their betas. And now I look at this and I say, which one has the higher Trainer measure? So portfolio P, that's got a Trainer measure of 7.68. Portfolio Q, wow, that even has a higher Trainer measure of 11, and the benchmark here has a Trainer measure of 6. So in this case, I actually find out that now it's flipped. In the last case with Sharpe ratio, portfolio P was the best, and now I find that portfolio Q is actually the best. So that's interesting. So Trainer measure here, just to summarize, note that the Trainer measure, the Trainer index, can differ from the Sharpe ratio. It's a different measure. Why? Because it's using a different notion of risk. Okay, and this is because Trainer does not include specific risk, whereas the Sharpe ratio does. All right, so that is Trainer measure. Key thing to remember about Trainer measure is that it ignores specific risk. It only uses market risk. Why does it ignore specific risk? Because there has to be some assumption that you're going to diversify it away at some point. Okay, let's hit the last measures here, alpha and the information ratio. Let's dive into that. So alpha is something that we've seen before. However, I'm going to introduce you to a different name for it, and that is called the Jensen index. Okay? So another name for alpha, or the abnormal return of a stock, is the Jensen index. The Jensen index, actually, when I was learning this material, I think more people called it the Jensen index. Over time, they shifted to calling it alpha, and now I think it's more established that people will call it alpha. But the thing for you to remember is in a problem or on an exam, if somebody refers to the Jensen index, just think, oh, that's alpha. And I've already calculated alpha. What is alpha? Alpha is comparing against the CAPM prediction. Okay? So remember that we just have a new name for something that we've already seen. All right, what was alpha, all right, or which we're calling the Jensen index now? Well, it was related to the security market line. Remember the security market line? That was our CAPM prediction. And so I had beta, and CAPM says, give me beta. Let me remind you of the CAPM equation. So if I have some stock that I'm looking at, CAPM says its expected return should be the risk-free rate plus its beta multiplied by what? The market risk premium. So this is just a plot of that. Again, think of CAPM as give me beta and I will predict your expected return. All right. Hopefully you remember what alpha was here. We're calling it the Jensen index in this context, but it's just alpha. Alpha was, well, here's my portfolio sitting right up here, or maybe it's a stock. And alpha was the difference between its expected return and what CAPM was predicting. CAPM predicts on the security market line. So that difference there, I'm sorry that I wrote over that, that distance there from the security market line, that's what alpha was. So alpha was basically how much above or below this expected return is compared to what CAPM predicts. All right. So we remember Jensen index, that was the vertical distance from the security market line. And it was we also used it as a measure of your ability to pick stocks. You want to find stocks with what? Positive alpha. Those are undervalued stocks. So we had all those interpretations of alpha. Okay, so a positive Jensen index indicates that we're earning a higher expected return than we should for our level of systematic risk. That's basically what it says. The problem here with the Jensen index, or alpha, is that what is it missing? It's all about expected returns, but there's no appropriate notion of risk. So we'll see that we're going to add that in a second. But first, let's go and let's compare these. So I go to portfolio P, portfolio Q, back to my same table, and I look at their alphas, and what do I see here? Portfolio P had an alpha of 1.6. That's great. It was outperforming what CAPM predicted. Portfolio Q is doing even better. It's got an alpha of 2.3%, so that's even more above what CAPM was predicting. The market always, by definition, is going to have an alpha of 0. Okay, so I look just at alpha, or just at the Jensen index, right? We know that that's a measure of the abnormal return, or the return in excess of a benchmark. That's a fancy way of saying that how much you are beating the CAPM prediction. Okay, we also remember that positive alpha indicated outperformance, negative alpha was underperformance. But should we rank our performance purely on alpha? The answer is no. Why? Because alpha, what is alpha missing? It's missing a notion of risk. So we're going to modify it, and that's going to lead us to the so-called information ratio, and that's going to be our last measure here. So let's do that quickly. So here I had alpha, but alpha was missing risk. So what is the appropriate risk to pair with alpha? Okay, and so that's going to lead us to the information ratio. And the information ratio is the ratio of alpha, or the Jensen index, to what? Specific risk. We're going to see specific risk is the appropriate risk to pair with alpha. Okay, so you can think of this as the abnormal return per unit of firm specific risk. Let me give you the formula here. So star this formula so you can easily find it. Information ratio of a portfolio is what? It's alpha, right? Alpha on the top, whether it is beating or losing to the CAPM, divided by, what do I have on the bottom? What do I mean by this? This is specific risk. So I'm writing this to represent specific risk. So alpha is abnormal return divided by specific risk. Okay, why is it appropriate to pair these two together? Let's think about it for a second. Alpha is what? Alpha is what CAPM, sort of above or below what CAPM is predicting. CAPM takes into account what? It takes into account market risk. Okay, so you can think of alpha as I'm sort of subtracting off what the CAPM says. I'm removing the part that CAPM predicted, right? And CAPM predicted based on beta. So the top here, alpha, think of, again, removing sort of the market aspect of that. And then on the bottom, I want a risk that also does not have market risk. Okay, so what do I do there? I remove the market risk. I'm left with just the specific risk. So the information ratio is basically taking out anything related to the market, right, and seeing what you have left over. All right, why would you use this? Why would you use this, and what is this appropriate? Information ratio is completely about specific risk, okay, and it's about are you earning a good return for the specific risk that you take on? Let's think about that for a second. If I don't take on any specific risk, I only have market risk. That means I'm what? I'm just invested in the market, and if I'm invested in the market, I'm going to earn what CAPM predicts, okay? If I say, hey, I'm going to do something different than the market, then what does that mean? I'm going to take on specific risk, okay? So that's the specific risk side of it. So now I'm doing something, maybe I'm picking stocks, I'm actively trading, I'm doing something different than just investing in a market index. So that's going to generate specific risk. And then I want to show that, hey, I'm actually making a reward for that. What would be the appropriate notion of reward for that? It would be the alpha. So information ratio is saying, hey, let's take out anything related to the market. Let's see your active trading. And are you getting a good reward, a good alpha, for the amount of specific risk that you are taking on from your active trading? Okay, so that's a good way to think about it. The book also has a nice interpretation of the information ratio. They say the information ratio is appropriate for stocks to add to an existing position in the market. Where does this come from? Again, think of the market associated with market risk and beta, right? And so you could have a position in the market. And then if you are trying to add a stock to the market, what are you doing? You are like stock picking. And we remember stock picking was related to alpha. And so you can actually show that if you can find stocks, if you can pick stocks that have a high information ratio, that is their alpha to their specific risk is high, and if you add those to an existing position in the market, that you actually raise your overall Sharpe ratio. So that's something that you can show. I won't focus on it a lot, but that relates to this interpretation that you'll see in the book. So the book is basically the following. I'm starting with a position in the market. That's my beta. And then if I'm looking for things to add to that to benefit it, I would look for things that have a high information ratio. The context that I've seen information ratio in a lot is more of somebody's trying to show off their active trading, right? Because if you're not doing active trading, what are you doing? You're just investing in a market index. That's sort of all beta. If you're doing active trading and you want to prove to somebody, like, I'm a really good active trader, I'm a really good stock picker, then they would show off their information ratio. So I think of like information ratio as like a Sharpe ratio, but for your active trading. Okay, so anyway, let's move on here. So we've got the formula here, alpha divided by specific risk. So we can calculate that for our different portfolios here. So portfolio P, portfolio Q, and the market. We calculate their information ratio. Portfolio P has an information ratio of 0.24. Again, I like to think of that as it's sort of like a Sharpe ratio for the active trading that was going on in portfolio P. Portfolio Q has a Sharpe ratio of 0.15, and the market by definition is going to have an information ratio of 0. Okay, so now if I compare these by information ratio, sort of which one, is demonstrating the best active trading, or the book's interpretation, which one would be better to add to an existing position in the market, that would point toward portfolio P. Okay, so information, this is sometimes called the appraisal ratio. We're going to call it information ratio here, so don't worry about that. Used a lot, like I said, in active portfolio management. The book shows that adding active portfolios or securities with a high information ratio to the passive portfolio, what's the passive portfolio of the market, raises the Sharpe ratio of the total portfolio. Okay, so that's the context that they like to put the information ratio in. All right, And again, down here, I have the interpretation. The volatility here represents the residual or the extra risk that you take on, not related to the benchmark, not related to the market, to try to earn that alpha. So information ratio is a measure of outperformance per unit of each additional residual standard deviation risk. Okay, so we went through a lot of measures here. This is a really nice slide to summarize everything. So let me walk through it. And what it has is it has our performance measures here. And we have three: the Sharpe, trainer, and the information ratio. We've got the definition of them. And look that they all have a very similar structure. They are some measure of reward, so like excess return or risk premium in Sharpe ratio divided by standard deviation, trainer excess return divided by beta, and information ratio alpha divided by residual standard deviation. So you should note that all of them are some reward over risk. And then finally, and this is very important, I want you to know this, in what context should you use these? Which measure is important in which context? So the Sharpe, when should you use Sharpe ratio? When choosing among portfolios competing for the overall risky portfolio. It is for your total portfolio. Remember, it comes from that context of capital allocation lines and mean standard deviation diagrams. What about trainer? So trainer, we note our notion of risk in trainer is just beta, just market risk. When is that appropriate? When ranking many portfolios that will be mixed to form the overall risky portfolio. The key term here is mixed. Why is that key? Because if you're mixing things, you're diversifying and you don't have to care about specific risk. That's why it only looks at market risk. And then finally, information ratio, and they have the context that the book highlights. When evaluating a portfolio to be mixed with the benchmark portfolio, that is, you have a passive position in the market and you want to add something active to that, information ratio is what would tell you whether that's a good thing to add or not. Okay, so understand those contexts. The final thing that we saw here was the M-square measure. So the M-square measure, think of that is tied to the Sharpe ratio. It provides identical rankings. It's just an easier way to interpret the Sharpe ratio. So M-square and the Sharpe ratio are, in some sense, you can think of these as identical. They will give you identical rankings. All the others are different. So Sharpe is different than trainer, is different than information ratio, and they can rank things differently. Okay, to finish this off, let's do a couple of problems. All right. First exercise here. Consider the Sharpe and trainer performance measures when a pension fund is large and well diversified in total and has many managers. The blank measure is better for evaluating individual managers. Let's stop right there. Let's see if we can tackle the first part before moving on to the second. So I want to compare between Sharpe and trainer measure, and I want to know which one is appropriate. Okay, the pension fund is large and well diversified. That's a key term, well diversified in total. It has many managers. The blank measure is better for evaluating an individual manager. So what do you think the answer would be there? I'll give you the answer. The answer to that one would be the trainer measure. The trainer measure. Why trainer? Let's try to pick up on a couple of key terms here. So number one, I note that they said well diversified. Well diversified means I should think I don't have to worry about specific risk. I've diversified it away. Okay? So if I don't have to worry about specific risk, again, that points me toward trainer because trainer divides by beta or market risk. The other is that I'm evaluating an individual manager and it has many managers. So again, that's the notion that I'm looking at a single manager and I know that that manager's portfolio or portion of the portfolio is going to be mixed with everybody else. And so at the end of the day, I don't care about that manager's specific risk because it's going to be gone. Okay? So that points me toward the trainer measure. Let's look at the second part. We can probably guess what it would be, but let's look at the second part. While the blank measure is better for evaluating the manager of a small fund with only one manager responsible for all investments, which may not be fully diversified. Okay, so this one here is definitely Sharpe. Why is this Sharpe? What are some of the key things? I'm not fully diversified, so I cannot ignore any kind of risk. And so standard deviation takes into account all risks. There's only one manager responsible for the whole portfolio. Again, we're looking at overall portfolio. So for measuring overall performance, we would look at the Sharpe ratio. Okay, so the answer here is C, trainer and Sharpe. Very good problem. Make sure you understand this and able to identify trainer versus Sharpe, which would be appropriate. All right, let's do a calculation problem. Kelly Blakely is a portfolio manager for the Miranda Fund, a core large cap equity fund. The market proxy and benchmark for performance is the S&P 500. Blakely was able to produce exceptional returns last year, as outlined in the table below, through her market timing and security selection skills. The risk-free rate was 2%. Okay, so let's note a couple of things. That's the risk-free rate. We can look at return, standard deviation, and beta of the Miranda Fund. We're going to call that our Fund P, okay, versus the S&P 500. That's our market. And we're given what? Return, standard deviation, and beta of these. And a couple of things we see here. The S&P 500, its return did really bad, whereas Miranda Fund actually made some money. That was good. Miranda Fund actually used a lower standard deviation than the market. Wow, and Miranda Fund had a higher beta than the market. Okay, so those are the things we note. All right, let's move on to the questions here. I'm going to note up here the risk-free rate was 2%, so we can have that as we go through this problem. All right, part A, it's going to have us just calculate a bunch of these performance measures. So let's make sure we're comfortable with them. What are the Sharpe ratios for the Miranda Fund and the S&P 500? Now this one is review. You might want to pause here, do the calculation. I'm going to reveal the answer. So we remember Sharpe ratio is what? It's risk premium here divided by standard deviation. If I calculate that for the Miranda Fund, the expected return on the Miranda Fund was 10.2%, right? Minus the risk-free rate. The risk-free rate is 2%. So that's on the top divided by standard deviation on the bottom. And I get 0.2216. Okay, so that's good. It was positive. And I do the same thing for the market. The market actually lost money, minus 22.5 minus the risk-free rate, divided by how much risk did it use, 44%. I do that, and I actually get a negative Sharpe ratio for the market, which is bad. Okay, so very clear here. Miranda Fund, in terms of overall portfolio, greatly outperformed the market. Let's move on to the second part here. What is the M-square measure for the Miranda Fund? M-square measure for the Miranda Fund. What does this get at? So in the first part here, I calculated this Sharpe ratio, and yes, it's positive. The Sharpe ratio for the market is negative, but is that easy to interpret? No. So we're going to move to the M-square measure. So for this one, you might want to look back in the slides, look up that formula for the M-square and try to calculate it on your own, and then come and see the answer that I'm going to reveal now. Okay, so the M-square measure. What was the formula for the M-square measure? Well, it was the following. We remember that M-square measure is equivalent to the Sharpe ratio. So first I have to calculate the Sharpe ratio. We did that in the previous slide. Okay, so it's the difference in the Sharpe ratios, and then remember what you're trying to do in the M-square measure. You are matching risk levels with what? The risk of the market. So that's why the standard deviation of the market shows up right there. So here, what do? I take Sharpe ratio of the Miranda Fund. We calculated that in the previous slide. Subtract off the Sharpe ratio of the market. That was negative, so I have minus a negative here. And then to match what? I'm going to match the risk level of the market. That was the 44%. So that's where this comes in right here. I take standard deviation of the market, multiply by 0.44. And what do I get? I get an M-squared. Now this is huge for an M-square. I don't know that this problem is realistic, but in this case, the Miranda Fund has an M-square of 34.25%. How do I interpret this? I say, look, if the Miranda Fund had used the same level of risk as the market, that is 44%, it would have beat the market by 34.25%. Okay, so that's easy to interpret, and that's like, wow, okay, it really would have beat the market. So there's the M-square measure. Let's move on to the next one. What is the trainer measure of the Miranda Fund and the S&P 500? Again, look back in the slides, find the formula for the trainer measure, and go ahead and try to calculate that. I'm going to reveal the answer. So the trainer measure is what? It's risk premium on the top, okay, divided by beta. We divide by market risk, okay? So here, Miranda Fund 10.2% expected return right there. The risk-free rate, let me remind you of that again, that was 2%, so I subtract off the risk-free rate of 2%. In this case, I divide by what? I divide by beta. So I get that, and I get 0.0745, or you can state this in terms of a percent, 7.45%. So how do I interpret this? This basically says for each unit of beta, the Miranda Fund was earning 7.45%, okay? Or it is the reward per unit of market risk. Okay, I could also calculate it for the S&P 500, the same formula. S&P 500, it's our market, so by definition, it must have a beta of 1. So I plug into that, and you're going to get a trainer measure of minus 0.245, or minus 24.5%. So again, Miranda Fund greatly outperforms the market. All right, let's move on to the last part here. What is the Jensen measure of the Miranda Fund? First thing you should remember here is Jensen is another name for alpha. So I just need to calculate alpha. All right, I'm going to reveal the answer to this. So what is alpha? I take the return that the Jensen Fund actually achieved, and I compare that to what CAPM would have predicted. This is the CAPM prediction. Okay, so that was our definition of alpha. And again, Jensen is just another name for that. So Miranda earned 10.2%. What did CAPM predict? The risk-free rate was 2%. The beta of Miranda Fund is 1.1. What did the market do? What was the return on the market? Minus 22.5% minus the risk-free rate. So I'm just plugging into CAPM. I take that difference, and what do I get? A difference of 35.15%. So again, just a humongous alpha here, the outperformance compared to what CAPM would have predicted. So Miranda Fund did extremely well. Now, I wish they would have put a last part of this problem, and the last part, which they didn't have, I would have liked for it to ask you to calculate the information ratio. And so let me just remind you, I won't do a calculation here, but let me remind you of what that was. That would have been a great last step. Information ratio was what? Alpha, which we just calculated, divided by standard deviation of specific risk. Now, they didn't give us standard deviation of specific risk here, okay? So we couldn't do that. But if they had given us the standard deviation of specific risk for the Miranda Fund, then I could have taken this alpha, divided it by that, and it would have given me the information ratio. Okay, so make sure you know how to do that calculation as well. All right, let's do another problem here. The risk-free rate, average returns, standard deviations, and betas for 3 funds in the S&P 500 are given below. They're given over here. So these are my 3 funds, A, B, and C. Here's their average return, 18, 25, and 20, standard deviation, and beta. And I'm also given information for the market, S&P 500, and I'm given a risk-free rate is 5%. All right, so that's the basic data. Let's turn to the question. If these portfolios are sub-components that make up part of a well-diversified portfolio, then portfolio blank is preferred. Okay, this one is not telling me just calculate this performance measure. Instead, it's giving me the context, and it's up to me to figure out which performance measure I should use. So let's think about this. What are some of the key terms here? These portfolios are sub-components. So they're not the overall portfolio, but they're part of the portfolio. They're going to make up part of a well-diversified portfolio. What does that tell me? Oh, if it's well-diversified, do I have to worry about specific risk? No, because that's going to get diversified away. So in whatever measure I use, I don't have to worry about specific risk at the end of the day. What measure is that? Trainer. That's the trainer measure. So by these keywords, they're trying to point us to calculate the trainer measure, pick the one with the highest trainer measure. Okay, so that's what you would do. Let me just quickly show you that. The answer is B here. The trainer measures, you would calculate trainer measure for each of these. Let's just do it for portfolio A, and I'll leave the other ones to you. So trainer measure is what? It is the expected return minus the risk-free rate. Okay, so risk-free rate is 5%, right? Expected return of A is 18%. That's that right there. Divided by what? Do I divide by standard deviation? No, I divide by beta. So beta is our measure of market risk. I get that. I get 12.38. And I'm going to do that for each of these portfolios, A, B, and C. I should also do that for the market. I didn't put it down here, but you would calculate it for the market as well. And you will find that B has the highest trainer measure. So that is the one that we would prefer in this scenario. Okay, so a very nice problem because it doesn't tell you what to calculate. You have to figure that out from the context. One more problem here. Okay, in creating the P star portfolio, this came out of the context of the M-square measure. So if you don't remember what the P star portfolio was, I won't expect you to remember what a P star portfolio is. But maybe go back and look at that slide in the M-square context, and there was a P star portfolio. One mixes the original portfolio P and T-bills, that is the risk-free rate, to match what of the market. So the essence of this problem is that in the M-square measure, you are trying to first match the what of the market, the alpha, the beta, the excess return, or the standard deviation. Which one corresponds to the M-square measure? And if we remember properly, it matches the standard deviation of the market. And once you've matched those standard deviation, M-square measure is just comparing expected returns. And that's it. And that's what makes it easier to interpret than the Sharpe ratio. Okay, that's it for our CAPM-based performance measures.